Hello everyone, I am Pratap here. We are at part 2 of lesson 12. This is a practical session to make you understand what exactly HTF, ITF and LTF means. So let me give you one real life example to make you understand this concept in much better way. We already learned HTF is for identifying the buyer's location and seller's location, and ITF is for identifying the trend, and LTF is for identifying our entry, target and stop loss. Let us understand these concepts with one real life practical example. For example, you want to visit a summer holiday trip. So during the summer, the climate is very hot. So you want to go or you want to visit a location having a pleasant climate. That means you have different options to travel. One option is you can travel to a desert area. We have a Thar desert in India. But during the summer day, do you prefer to visit this location as your holiday trip? You have another hill station, a beautiful hill station, Mussoorie at India. We have a very beautiful scenic location, Srinagar at India. So you have different choices. You can visit any of these locations. But what is the objective? You want to visit a pleasant location because this is a summer holiday trip. The climate is very hot. So that's why you are looking for a location having a pleasant climate. Exactly the same way, when you want to buy a stock, the location is also very important. We have two kinds of locations. One is buyer's area and another one is seller's area. Of course, you have one more location is also there, that is in between buyer's and seller's location, and we named it as equilibrium. What is your objective? Your objective is you want to buy. When you want to buy, which area is good? Buyer's area is good, or equilibrium area is good, or seller's area is good. That is what you have to take a decision based on your objective. So, in our real life example, our objective is we want to visit a location having a very pleasant climate. So, do you prefer a desert area with that objective? No. So, exactly the same way, when you want to buy, do you prefer seller's location? No, we don't prefer seller's location. Okay, suppose you identified a proper location. Maybe you want to go to either Mussoorie or Srinagar during your summer visit. Because the location is excellent, is that enough to plan your trip or something else you need to monitor? The something else we named as a trend. So the trend could be climatical situation in our real life example. Suppose there are landslides. The location where you want to visit, there are landslides. Do you prefer? Assume landslide occurred recently. Then do you prefer? So your way is blocked. So how do you reach your location? It is not possible. Or maybe the location you want to visit, there are floods are there. When floods are there, do you visit that location? Is it possible to enjoy your holiday trip? It is not possible. Or maybe the location where you want to visit, the heavy snowfall is there. If there is a heavy snowfall, is it possible for you to go around the sightseeing places? You have to limit yourself to stay within the hotel itself. That means, do you enjoy your holiday trip? It is not possible. Then what kind of climatical situation you are expecting? You are expecting a pleasant sunny day. that supports your holiday trip to get maximum success from your holiday trip. The same thing in our technical terminology we are calling as a trend. But in stock market, the trends are three types you already learned. We have uptrend, we have downtrend, we have sideways. Suppose if you want to buy a stock, in which location you want to buy? In buyer's location you want to buy. Even equilibrium is also acceptable, but not seller's location. Let us assume you identified your trade in buyer's location. That means you identified an excellent location. But assume the trend is downtrend. What is the downtrend is indicating? The prices will go down even though we are in the buyer's location. That means our current price is at the buyer's location. Our zone is in the buyer's location, our demand zone. Still, you cannot take your trade because the trend is not supporting. Exactly the same way when you want to visit a holiday trip, you want to go to Mussoorie, but unfortunately there is a landslide happened. Or you want to visit Srinagar, unfortunately there is a heavy snowfall. That means trend is not supporting you. That means climate is here. Trend means climate in our real life example. A climatical situation is not supporting. Even though we are in a good, we have selected a good location, at the time the climatical situation is not supporting. Exactly the same way in stock market also, even though you identified your demand zone in buyer's area, still the trend is not supporting. We cannot trade against the trend. We already learned. Trend is our friend until the end when there is a bend. When trend is your friend, you want to take a buy decision, your trend should be your friend. That means it should be an uptrend. You cannot make your trend as your enemy. In a downtrend, if you want to buy, you are making your trend as an enemy. That means you are trying to go against the trend. See, if we want to get success in our holiday trip, we need to have a pleasant climate. Not only the location, even the climatical situation also should support. We have selected an excellent location, but climatical situations are not supporting. Exactly the same way, you have selected an excellent buyer's area, but unfortunately, the trend is not supporting. When trend is not supporting, prices will move against to our expectation, even though the location is good. This is the important point you should learn from this real life example. So as we already learned, we use a HTF time frame for identifying the location. We use ITF time frame for identifying the trend. And what about your entry? Your entry will be identified in the LTF time frame, that is lower time frame. Your entry, your stop loss, even your target. For example, if you take your holiday trip, what is entry, what is stop loss, what is target? Let me explain in a simple way. For example, you want to go for your holiday trip. In that holiday trip, what is the cost of your flight tickets? What is the cost of your hotel reservation? And what is the other cost of your local sightseeing? Everything, your total cost, whatever you calculate, finally you decide, you identify an amount. That could be your entry, the place where you want to buy in stock market. Then what is stop loss? Suppose if something happens against our analysis, what is the loss you can accept? What is the maximum loss you can accept? Suppose in this holiday trip, if something is happening, you plan the trip, you reserve the tickets, you book the hotel, So everything you planned. Now all of a sudden some emergency work you got. So you have to cancel your trip. When you cancel your trip, you have to cancel your tickets, you have to cancel your hotel reservation and the other local sightseeing reservations, everything you have to cancel. After cancellation, what is the refund you are getting back from your flight ticket reservation or from your hotel reservation, whatever the amount they are refunding back. So from your total amount you paid and whatever the refund you got, the balance amount is your loss. Is that loss is acceptable, or is that loss within your acceptable limit? If it is within your acceptable limit, then only you will plan your trip. Otherwise, you don't plan. And that is your stop loss. Exactly the same way, when you are planning a trade, what is the maximum amount we can able to accept if the trade goes against to us? That is what you identified as a stop loss. Then what is our target? The target is reaching your destination. That is your sightseeing location. There you spend your holiday time, and finally after you spend whatever the enjoyment you are getting, is it within your accepted level? The accepted happiness is going to be target in this real life example. But in stock market, what is the accepted profit you are expecting? That is your target. What is the expected profit? Similarly here, what is the expected happiness you are expecting from this trip? That is the target. So this is the way you can compare this concept with a real life example. Now let us get into the actual practicals and we will analyze the charts. In case if any of you are attending this lesson first time, please understand we are providing free training, complete free training on supply demand zone price action. You can visit our YouTube channel and you can go to the home page. You can click on the home page and then scroll down to the playlist supply demand zone price action course. So click on this playlist and you will be able to access all the lessons starting from lesson 1.1, 1.2, 1.3, lesson 2, 3 until the most recent lesson. And even all the upcoming lessons will be placed under this playlist. So please go through all these lessons one by one starting from the first lesson. And after that you can get into this practical lesson.